I think that this is going to be a story that gains a lot of traction over the coming weeks and months. I think that the price of silver is just beginning. I really, truly, truly do. And that nonsense of a outage, a glitch and an outage of air conditioning at the CME, a cooling failure, is a bunch of crap because only the metals markets went down. The other CME markets like the bonds and the FX and the repo and the equity futures, well, they stayed online. It was a technical failure isolated to only one asset class and low volume that day, yet the whole thing went down. To me, it just is telling you that things are breaking. And I don't know. I think that this is just the beginning.
In recent weeks, the precious metals industry has been grappling with unprecedented strain, with Andy Schectman warning that the retail bullion supply chain is entering a phase of extreme pressure. Silver Eagle inventories are thinning far earlier than usual, premiums remain volatile, and delivery requests on major exchanges are accelerating at a pace rarely seen before. In just the first 2 days of the December contract, more than 2.3 million ounces of gold and over 41 million ounces of silver were demanded for physical settlement, levels that mirror the heavy offtake trends reported since early autumn. Schectman notes that this rush for actual metal, not paper derivatives, marks a significant shift in investor behavior, indicating rising concern about the reliability of traditional delivery mechanisms. At the same time, Schectman highlights growing structural stress across global exchanges, pointing to the Comex and London markets as examples of systems under increasing strain. Large short positions, thinning inventories at the LBMA, and a surge of metal flowing out of registered categories suggest the foundations of the paper-based pricing system are weakening. Schectman argues that trust, the core pillar that enables futures markets to function, is eroding as more participants demand physical settlement rather than contract rollovers. He compares the current moment to a bridge that safely holds weight for decades, only to fail suddenly, emphasizing that the signs of structural fatigue are now too significant to dismiss. These pressures are unfolding alongside broader concerns about market transparency and systemic stability, amplified by recent technical outages affecting only metals trading and reviving suspicions about deeper underlying issues. Schectman believes these developments signal the early stages of a major shift, in which real metal becomes far more valuable than its paper representation, and traditional pricing mechanisms begin to fracture under the weight of sustained physical demand. With ongoing questions surrounding central bank activity, large unreported buyers, and unexplained metal withdrawals, Schectman maintains that the precious metals story is only beginning to unfold, and that the coming months could force a dramatic reassessment of supply, trust, and price discovery across the entire sector. Now, we present the clips from Andy Schectman's With Liberty and Finance. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
Only 2 days, well, today's day 3, I don't have the numbers yet, but 2 days into the December delivery month, and there's already been 23,970 gold contracts that have stood for delivery. That's 2.397 million ounces, and plus 8,305 silver contracts, or 41,525,000 troy ounces issued and stopped so far, and the month has just started. It's also relevant to note that in November, which I would say was not normal, the silver deliveries ended the month at just under 20 million ounces, about 19.7 million, which it's really crazy because November is not a scheduled delivery month for either silver or gold. There was 1,267,000 ounces of gold delivered. Issued and stopped is the correct terminology. But, the first day, this month, the December contract, day one, we saw 7,330 contracts stand for delivery in silver, which is 36, almost 37 million. That's more than $2 billion worth. And although it's not a record, it's close to it. April was the biggest record of just under 12,000 contracts. But to see a 2-day, that's day 1 and 2-day obviously added more, but it's just insanity where there's already been 2.4 million ounces of gold and almost 42 million ounces of silver delivered in 2 days. This is the same type of volume that we've seen all year long. And, it's funny, you and I started talking about this in 2020 before anyone did. And now it's just mainstream mainstream in our business. And I think this will continue until it doesn't, meaning until stuff is just depleted. And it's becoming more and more obvious that this is an imminent deal. At the same time, you have one of, if not the largest short position in Comex futures market, along with a massive short position in SLV, one of the largest ever. And at the same time, you have the LBMA, which is running on fumes. And, it's a situation where the delivery via mechanisms are breaking down. Almost 90 million ounces have been delivered off of Comex since October, since October 1st, 90 million. It's accelerating at a level that I don't think people understand or take for granted. And I think the way that you break that up is just to simply say that, let's make an analogy, right? For years, everyone pretended that, let's call it a cardboard box was full of cookies. There's a picture of a cookie on the outside. And the thing of it, and they would trade that. But now everyone is saying, no, I want the cookies. And people are realizing that the box is pretty much empty. And when that happens, this pretend cookie game, which you could call the derivatives, falls apart. And real cookies, gold and silver, become much more valuable. And that's why prices are rising. And why the dollar and other currencies may look weak when the truth comes out. So, yeah, I think it's a big deal. There was this report that JP Morgan shifted its offices to Asia in the middle of the night, that they were told that the people had like 5 days to move their family and everything to Singapore. I believe that is false. So everything that I'm reading tells me that that's not true. I guess we'll find out and we will see, but I know a lot of people have been asking about that. The bottom line, then again, to me, is that the market runs on trust. And when you believe that you'll get delivery of what you were promised, and that trust has been built up over decades, then the system works. And you buy a contract, you can stand for delivery. The metal's there. That's why Comex has set the price of gold and silver forever. And the analogy is like a bridge that handles a whole bunch of weight until it doesn't, like the 35W bridge in Minnesota that collapsed that I drove over 5 million times. And you're seeing that in London. You're seeing that in the Comex now. And I don't know. I think that this is going to be a story that gains a lot of traction over the coming weeks and months. I think that the price of silver is just beginning. I really, truly, truly do. And that nonsense of a outage, a glitch and an outage of air conditioning at the CME, a cooling failure, is a bunch of crap, because only the metals markets went down. The other CME markets, like the bonds and the FX and the repo and the equity futures, well, they stayed online. It was a technical failure isolated to only one asset class, and low volume that day, yet the whole thing went down. To me, it just is telling you that things are breaking. And I don't know. I think that this is just the beginning. We saw 12.5 million ounces were transferred out of the Comex registered category on November 26th. So, where's it going? Who's buying it? How caught are they? These are the things that I would be focusing on right now. To me, that's the most important thing to talk about today.
Your comment about the Comex reminds me of what happened during the nickel market run-up a couple of years ago. Our mutual friend, our dear departed David Smith, talked to us about that at the time and said, this is a private club. They can change the rules anytime they want. It reminds me of George Carlin's statement that it's a big club and you're not in it. But any comments that you have about the fact that on Friday, when silver was breaking out to a new all-time high monthly close, that's when all this shenanigans seemed to happen, when the trading was halted for 11 hours on the Comex. Any comments from you about that?
I would just simply say that if a market loses trust in how prices are discovered, or if it can quickly shift the rules, so too will the price discovering. It will shift elsewhere. And to me, all roads lead to the same place, and that's Shanghai, which becomes the price mechanism for physical silver. It will take over for the Comex. And, you know, when you play these games, we've seen it now in London with the nickel market. We're seeing it here. It's what they did to the Hunt brothers. They changed the rules. They'll raise margin requirements. They'll do all of these things. But when you end up seeing, you know, when you end up seeing a failure of trust, a massive breakdown in trust, I believe that shift will happen. And, you know, it will kind of be like London losing its grip on oil pricing, and move to the NYMEX. And, you know, they ran it for a long time. Now they're an afterthought. The same thing will happen here, I believe, that the world will be so angered, if you will, by the fact that this has been a game that has been played for a long time by the West, that it will move to the part of the world that, the center of gravity will move towards Asia, I guess is what I'm trying to say. So, yeah, I think that that's going to happen. I don't know when, but ultimately, in a world of probabilities, I'd put a high level of certainty on that at some point, it just moves to the part of the world that is cash and carry instead of promises and rehypothecation. In other words, you buy in Asia, you pay your money, you get your bars, and out you go. And before you buy it, you have to buy a bar from one of the pre-approved refineries, and they laser etch the number of the contract that you have on that bar. There is no shenanigans there. It's all about shenanigans here in the West.
The prolonged Comex shutdown has intensified scrutiny over the reliability of Western precious metal pricing systems, raising new questions about transparency, structural stability, and long-standing market practices. When a major exchange halts for nearly half a day during thin holiday trading and offers explanations that fail to reassure participants, confidence naturally begins to fracture. Such disruptions reinforce the growing perception that price discovery is increasingly vulnerable to rule changes, concentrated short positions, and settlement practices disconnected from the physical market. As trust weakens, attention continues shifting toward regions operating on a straightforward cash and carry basis, most notably Shanghai, where metal must be fully backed, verified, and delivered. The contrast between physical settlement models and Western paper-based structures is now at the center of the debate over where future price leadership will emerge. At the same time, the surge in physical demand and the strain on inventories underscore a deeper imbalance that is becoming harder for the market to conceal. Reports of a large delivery request, combined with aggressive sovereign stockpiling and expanding industrial demand, highlight the increasing difficulty of maintaining oversized short positions without triggering systemic stress. Analysts such as Andy Schectman argue that a single major institution exiting these positions could trigger a rapid chain reaction, forcing widespread short covering and accelerating a shift in global price discovery. In this view, the recent halt is less an isolated technical issue and more an early indicator of a system approaching its breaking point.
The technical analysis would say you take the cup and handle when it breaks through the handle, which it has at over $50, that you take the top of the cup in 1980, which was 50, the bottom of the cup, which was $4 in the 90s, and the difference is 46. You add it to the top, and that would say $96 would be the next technical resistance level, if any, or that would be the projected next place to go. And if you take a 42-to-1 ratio right now, or even call it 45-to-1, where it's averaged for the last 100 years, the silver to gold ratio, even though it's been coming out of the ground for 5,000 years, it's 16-to-1, and now it's 7-to-1, meaning it's depleting in nature. The price ratio, largely because of, in the Western world, gold's role as a monetary metal and silver's role in industry, it's average about 45-to-1. So you take gold today at 42.40 and divide by 45, and what do you get? 42.40 divided by 45 is $95. Well, isn't that interesting? That would be where it would tell you to go, where you take the top minus the bottom, which is 46, add it to the top, that would say $96. So I mean, if you were to see silver at the end of the year at $96, it would not be crazy at all. And if you take 42.40 and divide by 7, it's going to be somewhere around $600, 605. As insane as that sounds, that would match the geologic footprint right now. So yeah, I think silver is the asset of a generation. And I want to always hammer it home. I'm not telling people to buy it to become wealthy. It is wealth. And the biggest money in the world is showing you that. The sovereign wealth funds and the central banks, who have now largely reclassified silver a critical mineral. The U.S. government has. The EU did it in 2023. China just did it, and they are restricting exports. And China, as we've said ad nauseum on your show, the second largest producer in the world, is flying to Peru and Mexico and buying doré and concentrate, paying twice what the rest of the world will, and ship it back to refine it. If they're the second largest producer, then why the hell are they doing that? Because it's worth far more than the currency used to buy it. The prices are wrong. They've never been allowed to reach full price discovery when you have the largest concentrated commodity, concentrated short position of any commodity of the 1,000 plus traded on Comex for years. It just speaks to the why. Why would it be the largest short position in this tiny little commodity? It's not for these banks to make money, is it? Sure, they do, but is there something bigger behind it? And we've talked about that forever. So yeah, what we're witnessing right now is the inability of the players that have used the Western dominance, which is big checkbooks, big pockets of cash, to continue to suppress the price naked. It's now an existential threat. And you're seeing that. The rumor is the reason they stopped is there's one big trader who took possession and would not roll it over a stamp for cash delivery, perhaps an Asian trader who wanted over 400 million ounces of silver. Give it to me. And so all of a sudden the cooling breaks down over Thanksgiving in one of the most thinly traded markets of all. So there's virtually no activity, but just those servers broke down. Right. So the point of it is that this signals, just like the LBMA said, sorry, it's not L plus or T plus 1, it's T plus 8 weeks. Right. We don't have enough manpower or trucks. The Western system is crumbling under their own narrative, and they are losing trust. And that ain't good when a system is completely built on trust and it starts to, as the water recedes, what's the old adage, you see.
Warren Buffett said, when the tide goes out, you get to find out who was swimming without swimming trunks. Yeah.
Right. And I think that's going to be a grotesque picture before it's all said and done. And that's why I think you're seeing a different narrative unfold amongst these banks, that maybe the game is over, and survival would mean breaking ranks and covering and getting out. You see one of those European banks do that, and then the whole game just implodes as the price skyrockets and shorts get squeezed and they cover, pushing the price up higher. This is a big deal, and I think it's just beginning right now.
The trajectory ahead suggests that the current structure of the metals market is approaching a point at which physical settlement demands begin to outpace the system's ability to respond. If even a single dominant buyer refuses to roll positions or accept cash substitution, the stress on inventories could shift pricing away from leveraged contracts and toward mechanisms built strictly on verified metal. Such a shift would instantly challenge long-standing assumptions about liquidity, expose weaknesses in paper-driven valuation models, and create a far more turbulent environment for participants accustomed to managed volatility. As this pressure builds, the most likely evolution is a gradual shift in price discovery toward jurisdictions that operate under transparent, delivery-based rules, diminishing the influence of Western intermediaries and amplifying the role of cash and carry markets. If this transition accelerates, traditional benchmarks may lose authority almost overnight, and valuations could reset at levels reflecting true scarcity rather than derivative behavior. How close are we to a moment when one major disruption forces the entire pricing structure to reveal its real limits? Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution. Thanks for watching.